Welcome to Thoughts on the Market. I'm Seth Carpenter, Morgan Stanley's Global Chief Economist, and today I'll be talking about the U.S. election and fiscal policy and what lessons we might be able to draw from the fiscal experience in the UK. It's Wednesday, November 13th at 10 a.m. in New York. In a lot of our recent research, the U.S. election has figured prominently, and we highlighted three key policy dimensions that the U.S. administration is going to have to confront: immigration, tariffs, and of course, fiscal policy. We're going to keep elections as a theme, but it might be useful to draw some comparisons to the UK to see what lessons we might have for the US. We think the experience in the UK, which recently proposed a new fiscal budget months after an election, is relevant, mostly because of the time between taking power and the budget being presented. While markets are in the business of anticipating changes, the process of actually creating policy is a lot more cumbersome and time-consuming. In this week, where we've seen lots of expectations already being priced in, it's probably useful to try to think about that process of forming policy in the UK and see what lessons it implies for the US. Back in May, the UK elected a new government, changing party control after 14 years. A key moment for markets came just over a week ago, though, when the new government's presentation of their budget for the next fiscal year came up. Now, we should remember the Truss government had faced a market test when the announcement of their budget proposals led to a big sell-off in interest rates. As a result, markets were keenly attuned this time to the new Labour government's budget, particularly because the U.S. fiscal position requires a primary balance to stabilize the debt-to-GDP ratio. And in particular, when their debt costs rise, when interest rates go up, the primary balances that are needed keep increasing if they want to keep the debt stable. Now, the new Labour government proposed to fill a funding gap through tax increases while simultaneously increasing government investment spending. To manage some of the communication challenges here, many of these proposals, especially about the tax increases, they were made public in advance. The likelihood of additional government spending was also well known, and UK rates had moved higher for months leading up to the formal presentation of the budget. But markets reacted on the day of the budget reveal despite all of that prelude. The degree of front-loading of the investment spending was seen as a surprise in markets, as was the Office of Budget Responsibility's concurrent assessment that the policy would lead to higher growth, higher inflation, and as a result, a need for higher interest rates. Now, conversations with clients have brought up the similarities of the US and the UK. U.S. interest costs are steadily rising as the cost of the debt reprices to the current yield curve. And over time, the ratio of interest expense on the debt relative to, say, the GDP of the country, well, that's going to continue to rise as well, and it will very soon eclipse its previous all-time high. So, fiscal consolidation would be needed in the United States if we really want to see a stabilized debt-to-GDP ratio. Markets will need to assess the credibility of fiscal policy, and the scrutiny will increase the higher the interest burden gets. The budget process for the US is much less clear-cut than that in the UK, and deliberations and debates will likely happen over most of 2025. And there's an additional question of how much revenue tariffs might be able to generate on a sustained basis. History suggests that trade diversion tends to limit those revenue gains. All of these facts taken together suggest that the outlook for U.S. fiscal policy will continue to evolve for quite some time. Well, thanks for listening. And if you enjoy this show, please leave us a review wherever you listen to podcasts and share thoughts on the market with a friend or a colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.